Today, the stock market is starting to pull back and we're going to find out very soon about the debt ceiling. First up, let's take a look at the S&P 500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Really quickly, don't forget about my Memorial Day sale where you can get 50% off 1 month of bank trade alerts or the stocks channel trading Discord community. You can find out how to claim that deal by clicking on the links below. All right. So today SPY was down 0.55% to close the month, and hopefully if you sold in May and went away, you did not sell your big tech companies. Without a doubt, the Nasdaq 100 was the top performer, and the Dow Jones and the Russell 2000 were the dogs. Now with the S&P 500 still stuck in this trading range, you're probably asking yourself, what is SPY waiting for? And the answer is the financials. That financial sector is still looking very weak, and SPY is still in this trading range between 416 and 420 on closing prices, which means we need to see a break of this range to tell us where we're going. You can see based on the price action, we're still closing above all the moving averages and we still have a bull trend. So there's nothing in the price action or trend that tells us we have to go lower. So what I suggest you do is manage your risk right here at the support trend line and support zone between 416 and 417. And if we break below it, just instantly get a lot more risk off, because we do have lots of gaps to fill to the downside at much lower prices. If we start to lose support and we start breaking down, we could come fill the gaps at 407, below 402, and just above 396. Now keep in mind I said it's possible, not that I think we are going that low. We simply need to watch the support zone right around 416. Also keep in mind we have the rising 20 daily moving average and support zone at 414, so you can choose which one you want to manage your risk from. Just keep in mind if we start losing support, that is our first indication, which is an instant indicator that the bull trend is weakening. If the bull trend is strong, we should be able to hold above this support and start marching higher towards the gap fill at 425 and the August highs at 430. So just keep in mind with the bull trend, the path of least resistance is still higher until price action breaks through critical support. So don't get bearish just for the hell of it. Wait for the price action to confirm it. On the Nasdaq 100 triple Qs, we were down 0.57% today, and we're still in the bear cave while trading between 350 and 360. This is where I'm giving a high probability of a pullback because we just went way too far, way too fast as we were approaching this critical resistance zone. So usually when you get too far overextended, we're going to at least come back towards the mean, which is going to be right around this breakout zone at 339 and the gap fill at 333. Whether or not we actually go that low is going to depend on a lot of factors, but do keep in mind this is looking very parabolic and usually these conditions do not last for long. A healthy pullback would take us back down towards 337 to 339. And then that would be our first opportunity to consider looking for strong support. Otherwise, we're looking for that gap fill below at 333. If we do continue higher and we break through 350, it is possible we do reach 360. But again, I consider this a very critical resistance zone and not one that'll be easily broken. In the Dow Jones, we were down 0.3% today, and the Dow Jones tested critical support yet again at that negatively sloping 200 daily moving average. And we do have a bear trend in the short term of lower highs and lower lows, so we're at the last leg of support for the bulls at 327. Below 327, we have a bear breakdown for the gap fill below at 322, and we need to break above critical resistance at 333 and 336 to get more bullish. On the Russell 2000 IWM ETF, we were down about 1% today, and price action is still below all of the moving averages, so we still have the bear trend, and we're still below this critical resistance at 176. To get more bullish, we need to break 176 and close above the gap fill at 181. Otherwise, we are still in this longer term downtrend below this negatively sloping 200 daily moving average. Critical support is 170, and on the way there, we do have a gap to fill at 171.56. And if we break below 170, we are very likely seeing 52-week lows because we do have this giant head and shoulders pattern that's going to confirm on a break below that neckline. On the ARKK ETF, we are up 1.71%, closing right on top of critical resistance yet again, which is 40.5 and 41.5. We're not getting bullish until we start closing above this critical resistance zone, and then we can run into the mid 40s. If we get rejected, look for high volume selling back down towards the gap fill below 36. On the VIX, we are up 2.63% today, and while the VIX is seeing a little bit of volatility in this range right around 18, we're not getting bearish until the VIX can spike out above 20, so we need to wait until the price action confirms it. On Bitcoin, we're currently down 2%, and Bitcoin is getting that lower high rejection from 28,000 and right back down at this very critical support zone at 27,000. At this point, we have two paths we can take, because if we bounce off 27,000 and break this high above 28,000, that is a short-term bull trend, and it will look like a bull breakout above this resistance trend line. However, wait for the confirmation in the price action because we're getting high volume selling, and if we do break down from a lower high, we are very easily coming down towards 23 to 24,000. On Tesla stock, we were up 1.38% today, and we did get the second day in a row back over the 200 daily moving average, and we did hold that support zone right around 197. We closed at the high of the day and outside the upper Bollinger Band, so while we are getting overextended, we are also developing a bull trend. For that reason, stay bullish above 197 with the next upside resistance levels at 208, 214, and then 230. If we start closing below 197, it is possible this was a bull trap, which means we could be coming back down to 183. On Apple stock, we were flat on the day, going absolutely nowhere, but intraday, we did have an intraday 52-week high, and we were trying to break above that resistance at 179, and the only resistance above 179 is going to be the previous all-time highs. Now keep in mind, we have this gap to fill below, just below 176, and another gap at 167, so if we start to break down and see high volume selling like we started to see today, we are very likely topping out at the previous all-time high, which means there could be a significant correction around the corner. So manage your risk very tightly right here around this support zone at 170 up to about 174. And if we start clearing through that support, it is very likely we're getting the full-blown correction in Apple stock, which could take us all the way down to the gap fill at 158.5. On the financials, we were down 1.06%, and the financials are still looking very weak, and there's a very good chance we're coming down to fill the gap at 31 because we still do have the bear trend. In order to get more bullish, I think we need to start breaking back over 33. On the industrials, we were down 1.36%, and we are starting to look bearish because we're now breaking down below 97, which is the 200 daily moving average, and we do have the bear trend. The healthcare sector was up 0.86% today, bouncing from that overextended downside condition, which means there is a chance we could start bouncing back up towards resistance at 130. Keep in mind that's resistance, and a rejection from there is still a lower high within a downtrend. On the energy sector, we were down 1.76%, continuing into the bear trend, and like I said before, I think we're trending down to fill the gap at 73. So jumping back over to the S&P 500, this is going to be a very volatile trading range, but we have a very well-defined risk level and we still have a bull trend. So in my opinion, it is beneficial to stay with the current trend, which is still bullish, and wait for price action to break through critical support before jumping ship. Keep in mind, all year long, the bears have had narratives on why we're going to crash and why we're not going higher, and we just continue to go higher anyway. So let the chart and the price action do all of the talking and block out all of that noise. Simply trade what the chart is giving you and manage your risk around these critical levels. Don't forget to take advantage of the Memorial Day sale where you can get 50% off your first month of bank trade alerts and or the Stocks Channel Trading Discord community. You can find out how to take advantage of that discount by clicking on the links in the description of this video and the comment section. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.